Welcome to your daily stock market summary from MarketSnap. What a day, folks. If you blinked, you might have missed $1 trillion in market value getting wiped out. We saw a massive rotation today, and it's the kind of action that really tests your conviction as a long-term investor. The headline? A blistering jobs report that was just too good for its own good, sending the tech-heavy indexes into a tailspin while money quietly flowed into the safe harbors. Let's break down exactly what happened and what it means for your portfolio. Let's start with the scoreboard. It was a day of two very different stories. The Dow Jones Industrial Average actually managed to eke out a small gain, but the real pain was in the Nasdaq, which got absolutely hammered, dropping over 4%. The S&P 500 wasn't spared either, falling about 2.6%. And if you want a snapshot of the fear in the room, just look at the VIX, the market's fear gauge, which spiked nearly 40% to close above 21. That's a big jump from recent complacent levels. The catalyst for all this chaos? A blowout May jobs report. The U.S. economy added a stunning 172,000 jobs, nearly double what economists were expecting. The unemployment rate held steady at a low 4.3%. On the surface, that's fantastic news for the economy. But for Wall Street, it was a nightmare. This strong labor market effectively slammed the door shut on any hopes for a Federal Reserve rate cut anytime soon. In fact, prediction markets are now pricing in a better-than-even chance of a rate hike this year. That's a complete 180 from just a few months ago. And the sectors that get hit hardest when rates go up? You guessed it, high-growth tech. The semiconductor sell-off was brutal, wiping out over $1 trillion in market value. The weakness started earlier this week after Broadcom's report, which, while strong, didn't meet the market's sky-high expectations for AI growth. That set the tone, and the jobs report was the knockout punch. We saw massive drops across the board. Marvell Technology down over 16%, ARM Holdings down nearly 13%, Micron Technology off 13%, and Intel losing more than 11%. It was a sea of red in the chip space. But here's where it gets interesting for a long-term investor. This wasn't a panic sell-off where everyone rushed for the exits. Instead, we saw a clear rotation. Money was moving out of the high-flying, richly valued tech names and into more defensive, stable sectors. The big winners today were the classic safe havens. Look at the large-cap gainers. Procter & Gamble up over 4%, Coca-Cola up 3.5%, and insurance companies like Chubb and Progressive all posting solid gains. Healthcare and financial stocks were also strong. This is the market taking a breather and reevaluating what's priced for perfection. And it wasn't just the defensive stocks. Berkshire Hathaway, Warren Buffett's conglomerate, was a notable mover, up over 2% on the day. That's often a sign of investors seeking quality and stability. On the flip side, Oracle was a big loser, dropping nearly 10%. The market is starting to question the massive, debt-fueled capital expenditure plans of some of these AI giants, especially in a higher interest rate environment. It's a classic case of show me the profits, rather than just the promise. Zooming out to the weekly performance, the rotation narrative becomes even clearer. The top weekly gainers among large caps aren't the AI darlings. You've got Rivian up nearly 19%, Axon Enterprise up 17%, and Deere & Company up over 10%. These are stories about execution, industrial demand, and specific company catalysts, not just riding the AI wave. This broadening of the market is actually a healthy sign for the long-term health of the bull run. And the worst performers this week? You guessed it. Chipotle Mexican Grill, Cerebras Systems, and Ulta Beauty all took a hit. This tells you that the market is getting picky. It's punishing companies that were priced for perfection and rewarding those with tangible, diversified earnings power. As a long-term investor, this is the kind of environment where you want to be selective. Looking at the sector action for the week, the story is consistent. Healthcare and financial services are the top-performing sectors. Energy also had a solid week, likely on the back of geopolitical tensions. Meanwhile, consumer defensive and basic materials lagged. This sector rotation away from pure tech and into value and cyclical areas is a major theme to watch. Now looking ahead, the earnings calendar for this week has some interesting names. We have reports from Medtronic, Hewlett-Packard Enterprise, and DocuSign. But the most important event might not be an earnings report at all. All eyes will be on Apple's Worldwide Developers Conference on Monday. This is Tim Cook's last WWDC as CEO, and the pressure is on for Apple to show a compelling AI strategy. How they position their AI future could set the tone for tech sentiment for the rest of the month. You can find exclusive earnings transcript summaries on MarketSnap. A few other things to keep on your radar. Goldman Sachs trading desk is calling this sell-off a buying opportunity, saying there's a disconnect between retail and institutional investors. Also, the chatter around the SpaceX IPO is heating up, with some index providers debating how to handle a potential $2 trillion-plus listing. And finally, a thought from Charles Schwab's chief investment strategist, who warns that markets are starting to look more like casinos with speculative trading. It's a good reminder to stick to your process and your long-term plan. That's a wrap for today's stock market summary from MarketSnap. Thanks for tuning in. It was a volatile day, but remember, rotations like this are a normal part of a healthy bull market. Don't let the short-term noise shake your long-term strategy. Keep your focus on quality, diversification, and your own financial goals. Make sure to like and subscribe for more daily market breakdowns and in-depth SWOT analyses. We'll see you next time.